I'm going to get back to my rock and roll roots today, Danny Moses. I think you'd be interested in this. Dan Nathan, I know you are as well. It was the fall of 1969 when the Beatles released their 11th studio album. That, of course, would be Abbey Road. It's a tremendous album. As a matter of fact, for you tourists out there, I guarantee that at one time or another, you tried to replicate that famous photo. By the way, this is the On the Tape podcast. I am Guy Adami. I'm back from San Francisco, Napa Valley. We can talk about that if you would like. Dan Nathan, always. Danny Moses, always as well. In a few minutes, we're going to be talking with Rebecca Patterson. You know her from CNBC. She's had a storied career. We're going to have a great conversation with her. But in the meantime, back to Abbey Road. Why am I thinking about it? Because on my 847 song Spotify playlist now, the Beatles actually represent a good deal of it. And Abbey Road is one of those perfect albums. And side two has something that they call medley. Of course, the song Something is on that album as well. I think that's the most recorded song of all time. Frank Sinatra has done it, a number of different artists. But medley comes to mind because one of the songs towards the end of it is Carry That Weight. And it's a great song. The whole medley thing is great. But when I think about Carry That Weight, and I heard it last night coming down here to Virginia, I'm in Virginia, by the way, I said to myself, that's a metaphor for the market, Dan. And as we sit here, Microsoft sits at a $2.1, $2.2 trillion market cap. A stock of that magnitude, in my opinion, shouldn't move, 8% in a day, let alone the amount of time that it did post earnings. But here we are. So when you see a handful of names, and it is a handful, and this is that same old story, sort of carrying the weight of the broader market, one has to ask his or herself, is this a good sign or is it an unhealthy sign? And I got to be honest with you. At this point, I don't know the answer to that, Dan.
No, well, I'm fairly certain on it. I think it is unhealthy. Over the course of, let's say, the last 2.25 years that we've been doing this podcast, I think that a lot of regular listeners would understand or they recognize the fact that we've been talking about this concentration among these top 5 or 6 tech stocks. And, again, there's been different times when it's been more important than others, right? And so right now, when you think about this and, we have these 6 names that make up 25% of the weight of the S&P 500. They're huge earnings contributors, right, to that, S&P earnings. And then they make up nearly 45% of the weight of the NASDAQ. And so I guess what's most important to me about kind of the way the market is trading right now, we have a NASDAQ 100 that's up nearly 20% on the year. This is Thursday into the close as we are recording. We have an S&P 500 that's up 7.5% on the year. I think it's interesting to note that the small caps, the Russell 2000, are actually down a little bit or flat on the year. So right now, okay, if you were to look at the S&P 500 being driven by the performance of a handful of stocks, I've seen some stats that if you take out the performance of these 5 stocks, the S&P is down meaningful. If you look at the equal weight S&P 500, it looks much heavier. It acts on a relative basis much worse. So a lot of stocks in the S&P 500 are trading very poorly, despite the fact it feels like we are out of the bear market of 2022. And I guess what's important about that right now is that NASDAQ stocks, and these names in particular, started selling off in late 2021 when the Fed said they were going to take interest rates off this zero interest rate bound to battle inflation. All right. And they were the hardest hit stocks in the first half of 2022. The bottom fell out in October of 2022 when rates weren't even where they're going to be next week with Fed funds at 5%. And so I guess the real important part about this right now with stocks like Microsoft, stocks like Apple, not far from their all-time highs, is that how much more of the heavy lifting can they do in the face of higher for longer interest rates, also at a time where we're starting to see weakening economic data, which leads me to a topic that Danny started introducing in the summer of 2021 of stagflation and what that might mean for equities and valuations on equities. And I think we're here, Danny.
Here comes the sun. Doo-doo-doo-doo. Same album, right, Guy?
Same album. It's a perfect album, really.
Yeah,
I mean,
really.
I'm not a huge Beatles. I mean, there's some people that bow at the altar of the Beatles, and I totally understand that. But in retrospect, going back and listening to some of their work, it's absolute genius. And as much as I used to like to discount the import of Paul McCartney, he actually was the brilliance in the band. I would try to take the high road and say that was George Harrison was sort of the thread of that band. But as it turns out, like many things, I was wrong. It is McCartney, followed by Harrison, followed by Lennon, and then obviously Ringo bringing up the rear. Back to you, Danny.
All right. Well, in the here comes the sun notion, I don't think that's what's coming here, but what Dan just talked about, let me break it down a little bit. So people have been hiding in Meta, in Microsoft, in Google, and they got confirmation, whether, they weren't looking for not getting confirmation, cognitive dissonance, whatever you want to call it. They got an excuse to stay there. And they also got the rest of the bandwagon to come in and jump into it and feel safe about being there because, yeah, things on the margin are definitely a little bit better for those companies. They had reset expectations, some of those, obviously, and now they're beating them. But think about this. A lot of it's coming through cost cutting. There is some revenue growth. A lot of it's coming through cost cutting that's going to be coming. And this AI thing, that's the CapEx they're going to be spending over time that's going to have a, quote, massive ROI that's going on. Separate those companies for a second. And they're behemoths, don't get me wrong. And when they cut costs, it's in the billions of dollars, obviously. But it comes with headcount reductions, right? It comes with all those other things. Well, if you look at the consumer-facing names, there's really been nothing in any of these things that's been a positive. Yes, Procter & Gamble, and you get price increases. And again, we've talked about this. That's going to hit a wall at some point. Here's what's really, really amazing to me. We are moving around on rates and Fed fund futures based upon the earnings of just 24 hours ago, Guy. I texted you, and I'll admit it. I said, this market feels terrible. It felt like it was, and all those things that were happening. So we get these earnings today, which certainly better on the margin than possible. What does that really do to change the landscape of the economic picture? Nothing, because the stock market's not the economy. So here now, Fed rate hike is all but built in, over 80% chance next week. And then another 25 is starting to lurk its way back into the system here in June, and the rate cuts are now getting pushed out. Based on what? Based on, lack of further tightening the capital markets, or coming off of First Republic, which I know we're going to get into in a minute, that's now clearly on the precipice of, being rescued, or something's about to happen to it, obviously. On that quarter, we're going to talk about it. But you can't just be that manic about what's happening and take a bank crisis that, that comes back into play again, if you want to talk about just FRC. And then you got to pick a side here. And I'm still on the side with this GDP number that came out today of 1.1%, with the draining of inventories that are going on. So right now, today, we got back what we lost yesterday in the markets. We're obviously back into the soft landing zone. Does it last a day, a week? I don't know, but I still stand by. We've made the highs in the S&P, at least for the first half of the year, kind of at that 4180 level. So,
yeah, but it's interesting. Listen, guys, it'd be ridiculous to ignore the fact, of the way Microsoft's trading, the way Meta's trading, the way Alphabet is trading a day after they reported, and really, Comcast is up 10% today. I mean, Comcast is up 10% after its earnings report, and so there's parts of the market that you guys have been very constructive on that acts really well. Guy, you in energy, Danny, you in the home builders and that sort of thing. So, is there a scenario, Guy, where you see what Danny just said, 80% chance of a 25 basis point hike next week? Even, I guess, if you're worried about inflation on one end and the economy is muddling along, let's say at 1.1%, right? But that's okay here. We're not in recession territory yet. And we still have unemployment that is not just as yet to tick up. Is there a scenario where you guys can see, again, stock market, not the economy? I'm saying this through the lens of the stock market, but the stock market right now is saying we're okay with 5% Fed funds.
That's what it's saying right now. And this is my interpretation. First of all, the question is, can you be wrong, Guy? And the answer is absolutely yes. If you follow Fast Money at any point over the last 16 and a half years, listen to the On the Tape podcast, watch Market Call, have come into contact with me, you know that I'm wrong an inordinate amount of times. So clearly that can be the case. But let me just say this in terms of what I think is going on. I think the lag effect of the Fed actions over the last 10 to 12 months has still not kicked in. I'm surprised by it, but maybe what I didn't take into consideration was the amount of liquidity that continues to slosh around the economy in a certain way. And quite frankly, and I think Danny would agree with this as well, the Silicon Valley Bank, as perverse as this might sound, it was probably the catalyst for this subsequent move to 4150 or wherever we are right now in the S&P. Because again, whether you want to acknowledge it or not, QT stopped, and to a certain extent, QE started again, was resurrected. Now, there's just a matter of time, and wait for it, Danny, before Maxwell's silver hammer comes down and knocks this whole thing out of commission. And maybe it's in the form of some other earnings we're going to get over the next, or maybe it's just time decay. Maybe at a certain point, this entire thing kicks in and the market participants start to feel it. But as long as passive investing is still out there, as long as people want to see past whatever in fact is going on in the economy is out there, yeah, the market's going to sort of levitate, and that's where we are. The irony, of course, is I wasn't with you guys last week. I was away. But when I left the prior Friday, the S&P 500, I think, was 4140-ish. And as we're sitting here today, the S&P is magically 4140-ish. It feels like a lot has happened, but effectively through that lens, at least through the S&P, nothing has. But getting back to the original point, carry that weight. I mean, look at Microsoft over the last 2 weeks, Google to a certain extent. Even Apple has caught a little bit of bid. So, I mean, these mega cap names are dragging everything along with it.
Let me tell you the one stat that does not resonate with me, this belief that once the Fed stops cutting, the last 15 times, 14 out of 15, the market has a positive return. There is no precedent for what we're going through right now. And I say that because the amount of debt that's out there that's going to continue to reset daily for small companies, private, public, whatever it might be, is coming, right? And so you're coming off a massively low base. Again, I'll say it again, 13 years of this. You don't just readjust and have a soft landing based upon that. So that part I don't get. The other part is that we don't get the Fed balance sheet until Thursdays, at the close, so to speak. So we'll know tonight. And I believe the Fed may have tightened, may have done a little bit of QT here over the last week or so, obviously stopping FRC from coming to the window or stopping some of these other banks potentially from coming back because they want to be able to tell a better story next week, that they continue to do their job. So this little hiatus here that we're on, but make no mistake about it. The good companies are good and you can own them. It's going to come at a price. And at some point, those companies, you can hide in them for a long period of time, but they get close to being priced to perfection. And I go back to what I said a couple weeks ago, and it's appropriate because Whirlpool reported earnings and they weren't great. This market is a washing machine. And Guy, you just said it. And last week when you were on, or the week before, Guy, you said, here we are again, 4130, 41. What has happened? And the underlying of what's happening, right? And I'll give it this. Maybe we're over halfway through earnings here, certainly on a market cap basis. We have Amazon and Apple to go. Obviously, we have some big names that are out there. But maybe the S&P earnings won't be down 6 or 7% in Q1. Maybe it'll be 4 or 5%. But it doesn't change to me what's going to be happening in 2Q, 3Q, and 4Q. So what if the earnings for the S&P end up at 210, 215, right? Instead of this 200 or 195. Point is this, I still think the market is very expensive. That being said, Dan, and to be constructive here, I say again, there are always things to own. And what is mind-boggling to me, and the SEC can look into this all they want, but they're never going to find it, is the lack of liquidity in the bond market. We have massive short positions obviously set up in U.S. Treasuries. We're seeing 20 basis points, 25 basis points move. That just tells you how unpredictable. If the bond market's that unpredictable, think about what the stock market truly is.
Yeah, well, and I'll just say this, the setup into the Fed meeting next week, I think a lot of investors right now, at least if you're looking at the way the stock market is acting here, are expecting kind of like a dovish raise, if you will, right? And so I think that we could all agree that the S&P and the NASDAQ are kind of at some levels. They seem to be technical inflection points. And I'll just mention this is that, going back to April 14th, Guy, like your last day before you went away for a week, it was all those big bank earnings, right? Remember, JP Morgan was up 8% on a better than expected print and guide with better commentary, but the stock was down a lot, right, over the prior month or so. So the sentiment was really bad, and expectations were just not high. And so where were we the other day? JP Morgan was filling in a lot of that move on the back of First Republic. This trading week started after the close on Monday. First Republic had a 12-minute conference call. They did not take any questions. They talked about the capital flight or the deposit flight from the bank. They didn't even include the $30 billion when they were doing the math that the 11 banks had put in, I guess, in March at the throes of this sort of drawdown, right? And so, just the lack of clarity about them, the kind of news that they might need to raise capital and really get some bidders for some of these bad assets. And they're not bad assets, they're just the held to maturity. They have the losses, and they can't, until they basically shore up that, they can't raise equity, right? And so what are we waiting for here? And we had a great conversation, guy, on Market Call earlier in the week, so you guys could find it, with Sean Ryan. He is the financial sector lead over there at FactSet, and he had a report out on insight.factset.com, bank crisis in remission but not over. And I thought that was really interesting. So a lot of the questions, and Danny, you may have a take on this, is like the Fed, the Treasury, the White House, the FDIC, they're not doing anything right now. And supposedly David Faber was reporting this on CNBC on Wednesday, that they're really putting pressure on all of these other banks that put those $30 billion in deposits into First Republic for 120 days to maybe help them with some of those bad assets, buy them at a loss. Because the question is, if the bank has to go into receivership because deposits continue to leave, then all of those major banks are going to be on the hook for it, because they all pay into the FDI insurance fund, right? So it's kind of going to be an interesting scenario. And I guess the question is that if they come at really bad terms, right, for the big banks to basically sieve First Republic, and then let's see where the equity is raised. You guys, this thing's down 98% from its all-time highs. There is no equity. It's about $1 billion. So I guess the question is it systemic? If it comes at really bad terms, or it doesn't get done, or it goes into receivership, is this likely to be a dominoes effect? And then are we talking about, and this is the point that Sean Ryan was making, it's just in remission, it's not over. It seems like we're in the second or third inning of this, Danny.
So total deposits are down to 50 billion, of which 30 billion is the 11 banks that put in the amount, right? So when you think about it, it's down to pretty much, on a relative basis, what they had at the peak, it's down to nothing. And they're trying to strike a deal right now, to your point, where they offload these securities at, quote, a premium, and in exchange give out pieces of the company, right? Or raise money and under good terms to these other banks that are out there. What I believe is going to happen is it's a JP Morgan Bear Stearns moment, in my opinion. And what the Fed can't do and Treasury can't do is punish these 11 banks who truly, did their part, obviously, to come. And then we don't know the ins and outs of what hand forced who, but look at this part, Dan, because this is an important takeaway. They have completely retrenched First Republic from the jumbo mortgage market, right? And they have a huge amount of high net worth private clients that are out there. Look at mortgage rates. There's less competition, obviously, when an FRC is not out there originating loans. Who's the perfect fit for this? In my opinion, it is JP Morgan, right, at a certain price. And so make no mistake, I mean, Jamie Dimon is a shrewd, smart banker. And so there are things going on behind the scenes for sure, Dan. It's a game of chicken. But the Fed cannot, in my opinion, let this thing go, or the FDIC cannot let this thing go, because then you're dealing with a situation, Dan, that you just made, where there is a contagion, because you'll lose the faith of the large banks. And as much as people are scared about the big banks getting bigger, it's a lesser of all the evils right now to kind of bring safety into the market.
For context, not that it particularly matters today, but so First Republic is having a decent day today, which is almost comical to say it's up maybe 11 or 12%. It's trading, I still think, south of $7. Again, for context, this stock was north of $215 in the fall, actually November of 2021, if you want to get down to brass tacks, which is not coincidental. As recently as a month and a half or 2 months ago, this was a $125 stock. Again, not particularly important. So I mention it because here we are around $6.50 or so, number one. So we've been saying for a while that we're going to see a take under at some point. A lot of people thought that might come in the form of Credit Suisse and UBS. Maybe. I thought there was more to come. Other people did as well. With that said, what's sort of the systemic risk, or more importantly, what are the knock-on effects of this? Again, just my opinion, but when you think about the U.S. economy, again, 75% of the economy is driven by people buying shit, whatever that is. I think small employers, small businesses, mid-sized businesses employ north of 70% of the people in this country. First Republic and other regional banks, and Danny can probably speak far more intelligently than I think there are over 4,000 banks in this country, most of them under the umbrella of a publicly traded company. they're in a bit of a pickle here because whether they realize it or not, I mean, there's going to be a flight to the perceived safety of some of these obviously systemically important banks. And we're seeing it. Just read their earnings reports. You're seeing the inflows that these big banks are seeing. So what does that mean? Well, if people no longer, small businesses no longer have the same access to capital, or if it's going to be more expensive, or some amalgamation of the two, that's not particularly good. That's going to really hamstring small business. If small business is hamstrung in this country, the consumer is as well. And that's what's happening. Credit conditionings are tightening. Small banks are, I don't want to say in trouble because that sounds a bit hyperbolic, but clearly marginalized. And that's all at the foot of what we've seen over the last couple of weeks. So it's not necessarily what's going to happen to First Republic as much as it is what's going to change consumer behavior and what's going to happen. And I think that's the next couple of chapters in this story.
You bring up a great point in terms of what are these other banks going to do? And here's the game of chicken. If you're going to announce an offering of some kind, you better have everything buttoned up. If you're a Western Alliance, if you're a PacWest or one of these regional banks, right? Because if the economy does turn, and we just had a 1.1% GDP number missed from 1.9, but that's neither here nor there. And by the way, I will note that the PCE within that number was much higher than expected, which is a problem for the Fed. But if you're one of these banks and you're on the board of a bank, what do? It's a game of chicken. All right, guys, we need to raise $3 billion, right? We want to sell these securities. If you start to do that and you haven't completely buttoned it up, your stock's going to go down 80%, 70% because you're showing weakness. So the backdrop guy of credit getting worse on the margin, not a catastrophe, getting worse, is only going to make it harder. Because if these companies have to take larger loan loss reserves, just normal cycle loan loss reserves, which are going to occur over the course of time, it's going to get harder. And that goes back to the commercial real estate exposure. We see articles every single day now on office. We have vacancies of 85% in some towers right now in San Francisco. It's written about. So that's kind of where we are. And I think that's what's really lost. It's lost on the Schwab argument. It's lost of, the Schwab argument, okay, the bank, they have 20-something billion in losses potentially to mark to market. But the backdrop for Schwab would be, what if the market goes down 25% from here? What if because that will force more questions and more things. And thankfully, a lot of these banks haven't had to, quote, deal with this yet. But I think that's coming soon.
You know, it's fascinating, Danny. So you just mentioned that this is kind of a Bear Stearns JP Morgan moment. And just to go back to March 15th of 2008, JP Morgan paid $2 on that Monday morning, right, for Bear Stearns. And that was kind of the backstop. And I think a lot of folks, at least investors, strategists, easily what the central bankers and the Feds were saying is like, that's it. We backstopped it. You know what I mean? There's not systemic risk here. And your point is, I don't think you're suggesting that this is going to be a redo of 2008, because if you think of just kind of the banks that we're talking about, they're generally much smaller here. But what's important to remember from the low, and it's just remarkable that they happen to be almost to the day, because it was March 15 when SVB, right, got basically taken under here and backstopped by the Feds, at least their deposits. So March of 2023, Silicon Valley, March 15 of 2008, Bear Stearns. And I'll just say this, the S&P 500 from 2008, March 15th to mid-May, it rallied 15%. Okay. Like it rallied 15% with market participants thinking that that was contained. Okay. The BKX rallied 20% more than the S&P 500 did. And we know what happened after that. So when I look at what's gone on here, the S&P almost touched 3,800. Here we are at 4130 right now, okay? And we still actually have not broken out of this range. So I guess what I'm just kind of putting a button on is like, it really feels very, very similar. There's definitely going to be more shoes to drop. And your point about Jamie Dimon waiting in the wings, listen, he could pay $3 billion in equity value and take all these assets, take all these deposits. They would see deposits rush into First Republic. They'd see the activity that they would able to do with these customers on the loans, right, increase dramatically. But he's waiting for something. And the equity is basically zero right now.
This is nothing like the situation, obviously, with Bear Stearns and JP Morgan, other than it could be the same suitor. Here's the irony. We talked about this before. These are securities that are effectively guaranteed by the government, right? I mean, here we are, mortgage-backed securities, treasuries, right? We know they're money good. And so the other ones weren't, because it was still an unknown at the time. What are these triple B? What you tell me the AAA mortgages aren't good? There was so much leverage in the system. That's the irony, I think, that's kind of lost on all this, and it's a mark-to-market moment. And I'm going to say one thing on, as long as we're sticking kind of Washington and so forth. So as of May 1st, the FHFA, right, which basically controls Fannie and Freddie, which again got bailed out back in that time period. Let's not, forget that, right? So they are basically changing these LLPA fees, right? These loan level pricing adjustment fees that, so for a conforming loan, which can be up to 726,000 or whatever, right? A wrapped loan by the government, right? That they're going to charge higher FICO scores and larger down payment people more at the expense of allowing, which I'm all about, everyone should own a home, lower income, worse credit, right? So it's not a major thing, but to me, from a moral hazard perspective, again, yes, housing market is certainly peaked. Forget about the home building stocks for a second. We're now basically incenting people that otherwise may not qualify and certainly may not be able to afford a mortgage to get into the housing market. Now, I'm all for that. I think people should have a right to own, but really at the expense of the higher credit. So you're now incented, at least in the mortgage world. And again, let's put this in perspective. On a $400,000 loan for a high quality consumer, it's $40 more per month. But the point is this, like, I have a real philosophical problem with doing, I would take it from somewhere else to incent people. Anyway, I had to get that off my chest because it happened last week and we did get a chance to talk about the show, but that's going into effect May 1st. And again, it's another agency in the US. And I just find it ironic that this is the same agency that bailed out Fannie and Freddie and saw firsthand what can happen when credit terms are too loose for borrowers that shouldn't be able to get access. So sorry for that.
And a broad chest it is, by the way.
Yeah.
So, it's interesting. We started this with carry that weight, and Microsoft quarter, just to go back quickly, was fine. But the excitement around the Microsoft quarter was, in a word, excessive. And Dan, you spoke to this the other night on Fast Money. Some of the enthusiasm out of Satya Nadella. I mean, I don't think, as a matter of fact, people said that they have never seen a call like that from a tech company in quite some time. So this whole euphoria around AI and everything about it is clearly driving the narrative. And so much of the gains, if not the entire gains in a name like Microsoft, is basically multiple expansion, which is fine. Listen, it's all good. It's part of the market. I'm not discounting it. The flip side of that coin, of course, is a name like UPS, which obviously is extraordinarily economically sensitive. And when you hear the commentary out of Carol Tomé, their CEO, I mean, it's in stark comparison to what Microsoft is saying. She is talking about an unanticipated slowdown in retail sales, the weakness in Asia. And when a name like UPS, which last I looked, I think is a $150 billion or so company, moves 10, 11, 12% over the course of a day and a half or so, move from, I think, 199 to down to 175 at one point, that's not statistically insignificant. As a matter of fact, I think that's the biggest one-day move in 17 years or something. So you got to take those things into consideration as well. On the one side of this equation, we have maybe well-founded euphoria around a lot of these tech huge names. On the flip side, you're hearing commentary out of the aforementioned Whirlpool that Danny talked about, and now UPS. It's just a question of which side's going to emerge victorious. Right now, it appears as though the bulls are sort of in the lead.
Yeah, well, this reminds me actually a lot of 2000 in the lead up to what was the top of the market. And again, the NASDAQ, topped out after the S&P, and the S&P was made up of, what we were calling back then old economy, stocks. And if you thought if you were looking at what they were saying, it wasn't particularly great. The price action in a lot of those stocks was not particularly great. And there was still a bit of enthusiasm from the internet names, a lot of the tech names back then. And so it's kind of funny because you just mentioned UPS. I would also throw in CAT. You mentioned Whirlpool. CAT was talking about weakness in China. So are we getting to a sort of as good as it gets sort of scenario? There was Cleveland Cliffs, didn't have a great quarter here. So a lot of the companies that we associate with the nuts and bolts of the economy, okay, this is the kind of bits versus atoms sort of situation. There's an increasing spread that's growing here. And just because the stock market is going up, again, being dragged up by 10 stocks around some unusual enthusiasm about some tech themes that are not likely to be a material part of their earnings anytime soon, makes me feel like we're getting a little bit off sides here.
I agree that, by the way, I'm going to get off the rails here a bit, and I apologize. And if we choose to cut this out, that's fine. But as you mentioned, as good as it gets, I obviously hearken back to Jack Nicholson, who was recently spotted on his balcony. But, I think Diane Keaton, Danny, is one of the more underrated actresses of our lifetime. You think about her range. Obviously, she starred in As Good as It Gets with the aforementioned Jack. But, her portrayal of Kay in The Godfather 1 and 2 was legendary. And, of course, she had a stint in those Woody Allen movies. I'm completely digressing here, but I think you know where I'm going. I think Diane Keaton does not get her just due. With this said, I pass it on to you, Danny Moses.
I want to bring this back to Microsoft. And one other thing happened in the last few days was that the Activision merger, as expected, was blocked, obviously, by the FTC. And there was a Barry Diller article finally in the Wall Street Journal last week, just in general on his businesses and Interactive. And I'll give the writer credit. He went back to it. He goes, "Whatever happened with that?" He goes, "I don't know. We're still kind of waiting to see." Let me remind everyone that the stock was 63 in Activision. And on January 14th, 2022, Barry Diller, David Geffen, and Alex von Furstenberg purchased tens of millions of dollars worth of call options at a 40 strike. And 4 days later, on January 18th, the deal was announced. It was done at JP Morgan off exchange, and it had a term of January 23. So that's now obviously gone. I don't know what happened with that, but I'd be curious if we get now finally some type of resolution on that. And I'll make the last point on these big companies that are getting bigger. Think about what's happening with Microsoft now. I'm happy for them, the $2.3 trillion company, as they move into kind of dominating this AI. And there's this unknown fear of what it means to the economy and what it means to companies. Rest assured, this whole break up the big companies type thing is going to get a lot more ammunition probably going forward. And what that means, I don't know, maybe there's even more value in some of these large companies if you kind of break them up. But I think it's something to keep an eye on here
well, and I'll just say one thing about, it was the EU and the FTC seeking to block this deal, $70 billion deal. Microsoft, with its move today, has just overtaken the level of where it was when they made that bid for Activision. And when you think about the excitement around their partnership with OpenAI, the investment in OpenAI, they actually may welcome this deal being blocked. And when you think about kind of how much time and attention it might take to push to get this thing done, then the integration of this company, and then when you think about just kind of Activision's revenue base and what they were buying them for, you may say to yourself, you know what? We're on to bigger and better here, and that frees up a bunch of cash. I think it was a stock deal anyway, but you guys get my point here. A lot has changed since the time that they did this deal. And if it was me, if I was Satya and I was listening to the way he was on that call the other night, I'd be like, you know what? We spent a lot of time in the late 90s and the early 2000s wrangling with regulators, and we took our eye off the ball of many different balls here. Let's stay focused on the thing, at least that the market is appreciating and affording them a 30 times EPS or a 30 times PE, which they have not had in a very long time.
Yeah, for sure. So I think there's a $3 billion fee that goes the way of Activision. Obviously, if this doesn't happen, and they're probably not in a bad spot either, Dan, to be honest with you, considering what's going on in the world.
I mean, keeping with the theme of today's show, I'm sure there are a lot of folks out there saying, guys, specifically, you never give me your money in the form of my stock picks. And again, one of the medley songs. But I'll say this, we've talked about home builders. Danny mentioned it earlier, and there is a complete disconnect with, my view on the economy and what's going on with home builders. But we have been pretty resolute. And if you look at Pulte Homes, for example, a stock that's not just making a 52-week high this week, an all-time high. And to a certain extent, you're seeing similar moves in DHI and Toll Brothers, not to the same extent. But the disconnect comes in the form of what we've talked about, sort of supply-demand imbalances. Those imbalances around, as Dan mentioned earlier, in energy as well. And so we're sitting here today. By the time you're listening to this, you will have heard from ExxonMobil and Chevron in the form of their earnings release before the bell. ExxonMobil was in an earshot, if not an all-time high earlier this week, which is pretty remarkable when you think about the run that it's had, the move in the underlying commodity, and some of the things that have been going on. So in my opinion, the energy trade still works now, albeit clearly compromised in some of the levered names. OIH has been under some pressure, but I'm not going to walk away from that. And I'll tell you something, as much as I'd love to say, check change and sort of cash in on the home builder side of the equation, it feels as though it has some room to run. So it's not all doom and gloom on the G Swizz side of things for sure.
Yeah, I think on the energy, again, people came in overweight, and when there's sexier things that appear to be out there, they'll sell energy and go overweight tech, which people were underweight in the year coming in. So, but I think at the end of the day, even in a downward economy, even in a recession that's, let's call it mild, these companies are going to be returning tons of capital, and that I think will be the message. And they probably want to be careful, given the given that they're being watched. Are they really going to talk about that a lot? Are they going to hammer it home? Or are they just going to quietly kind of do it and not make a big deal about it? Because at the end of the day, these are very safe companies to own, almost not at any price where oil and gas go. But my point is this: I think there'll be a flight to safety, ironically, even in a downward economy, that will be financials once we get past kind of this FRC and these other companies, and an energy towards the back half of the year. And as it relates to the builders, I mean, it's really funny. It's a really local business, right? I mean, it's people are moving. Some are moving out of the big cities, buying their first home, et cetera. And their stocks don't look expensive. Certainly 6 times earnings, 7 times earnings, right? But when you look to what maybe 24 earnings might look like, right? They probably are very expensive. So I would not own the builders here at these prices, to be honest with you. Obviously, you need to get more sign that the Fed's going to actually cut rates. But we talked about the banks, some of them pulling out of the lending business and mortgages. Mortgage prices are staying high. Mortgage rates are staying high, even in the days or the weeks that rates come down. And I think that's something you have to pay attention to, and affordability. And last thing I'll say is the housing stocks saved themselves because of the supply chain issues. Make no mistake about it. If there weren't those supply chain issues in 20 and 21, they would have overbuilt, and they got in a sweet spot. So they're one of the beneficiaries, I think, of kind of what happened in the global supply chain, so to
Yeah.
speak.
Hey, I want to make one point. We're not going to have a big conversation about this, but I wanted to say something about Tesla here, which it was kind of an interesting week here. And just by the way, if you want to hear, Guy and I had a conversation yesterday. It dropped as a bonus episode in the On the Tape podcast feed with Kara Swisher. She is the host of the On podcast, the Pivot podcast. You all know her as a storied tech reporter here, but we talked a little bit about Elon. And one thing, we didn't really talk about Tesla, the stock. We just talked about some of the situation that he might have had just from, a liquidity standpoint. When you think about last week, that negative free cash flow turn in Tesla, pretty bad quarter, what happened with SpaceX, with the rocket that blew up here. And interesting conversation. But this stock, this morning on Thursday, traded just below 153. Guy, it filled in the entire gap, okay, back to January when they reported that Q4, right? And I thought that was really interesting if you think about it, and pretty sort of symmetric sort of move. I just want to be clear. I took some off. I rolled some of my bearish position, Danny. So like the idea of what I had in options, okay? So I took some of the meat of that trade that worked really well off, and I rolled it out a little bit and down, and therefore locking in some profit. Is that a level where the stock could bounce? No doubt about it. But the other thing, Danny, I wonder, that stock, after the initial 10% gap after it reported earnings, kept on going down all week. And you know that they have this blackout period for insider selling. Do you think there's a chance that insiders were selling, possibly Elon, a guy who said that he was not going to sell any more stock, that he said that after he was done selling stock late last year, I guess. And the only reason I bring that up is because Twitter is not a publicly traded company anymore. He took out $13 billion in debt. We know that in December, their sales were down, or their revenues were down 40% year over year. And I'm just bringing this point up, is that Discord, which I obviously many people think is a similar sort of business model, there was a report in the information this week that their sales, their revenues were down 40%. So it's kind of across the board here. And so to fund that debt, right, that debt payment, he's got to raise capital, kind of illiquid here. And I'm just curious, thoughts on that. I just want to be really clear about what I was doing. I've been negative. Danny, you've been negative. You've been short here, but there's a lot of inner moving parts here.
Yeah, so I think we'll find, if that's him, we're going to have to find out, right? It's like a 3-day maximum time frame, I think, when you have to see if it's selling. So we shall see. When it has traded like that in the past, that certainly, put it this way, Dan, that was long selling. That was not short selling that took the stock from the kind of the low 160s to the low 150s. You can always tell when it's going to be that. And I'm still standing by that it's now going to become more of a cyclical trade here than this, tech trade or whatever it's going to be. So the multiple keeps changing. We've had 2 downgrades. I am staying short. I've expressed it, Dan, mainly through the TSLQ, just being long that. So I don't have to deal kind of with the option expiration and the volatility there. But I do hit options from time to time on
Yeah,
those.
no, I've been trading both, and it's actually a good trading vehicle. One last point, Guy, I want to get your take on this. Mary Barra at GM, they actually some of the stuff that they had to say in and around EVs was pretty constructive, and the quarter looked pretty good, and the stock is down at a level. This stock was trading north of 42 in early February. Here it is just trading under 33. Technically, there's a lot of good support. There's valuation support. It seems like they're not going to play the game on these kind of this price war a little bit. I don't know. Do some of these US autos start to look a little interesting because they don't have the same yoke around their neck that, let's say, a pure play on the EV space has right now? Because I don't know, this one, I'm almost thinking about a little pairs trade here. If Tesla were to bounce, I might lay that back out what I took off, and I might buy a little GM and have that as a kind of barbell trade here.
If you look at GM, the chart, I mean, forgetting about sort of that huge spike we saw in early 21, when I think the stock was north of $60. I mean, everything was sort of going parabolic. But this stock has been since June of 21-ish. It's been like 31 and a half to sort of like, I want to say $40-ish, and we're at the lower end of the range, to your point. So that's been support. So I don't think entering a long trade in GM is disastrous by any stretch. But I also think it speaks to the competition that's been coming for quite some time that I think she alluded to. I think part of the weakness in Tesla is on the back of that. And again, don't discount the fact that I think, and I might be off by one at this point, but they've lowered prices 6 or 7 times, they being Tesla, this year. And their margins, which has been such a big part of the story, which, by the way, in the fall of last year, they said would probably trend lower, but wouldn't get down to the historic OEM levels, which is about 16%. I got to tell you something. Those margins are going to come in south of 20% at some point. And I think that's when the alarm bells are going to go off in terms of the stock. Just my opinion. So we'll see. But I definitely, Dan, think you're onto something on the GM long side. And just sort of to finish up with our Beatles theme, as both of you know, I never puffed the Magic Dragon. That's not a song on the album, I know, so leave me alone. But there is a song, Octopus's Garden, which is just dumb. But that was clearly marijuana-induced. We're through 420, which is meaningful to some people out there, not I. And of course, if you listen to the song Come Together, the Timothy Leary influence of that song is all over. So there is some marijuana elements to that album, which all roads lead, including Abbey Road, to cannabis. Danny, I know you have some thoughts on what's been going on.
Well, the Safe Banking Act has been resurrected in this Congress, and it has sponsorship on both the Senate and the House side, and it's never really been introduced into the Senate to kind of start. So that's a big event. It's passed the House 6 or 7 times and never made it to the Senate. So we'll see what's going to happen here. Obviously, the stocks are reacting. I just think it's the time of common sense. It's such a cash business. There's robberies. There's inability of social equity license holders that can't even get loans from some of these banks. And it's ironic we're talking about it while some of these banks are in trouble with traditional banking. We'll talk about cannabis banking, but it is something to keep an eye on here. And again, remember the descheduling conversation or rescheduling conversation of the drug itself is currently ongoing. And so we'll see what happens during the course of the year, but certainly a positive moment for the sector. And Brady Cobb, who obviously runs Sunburn, was quoted today in a CNBC article talking about it as well. So it was decent commentary. We'll see what happens. So any momentum is good momentum when it comes to cannabis, Guy.
Brady Cobb is a very handsome man. I'm comfortable saying that. As I said a number of times, like he reminds me like he should have played linebacker at the University of Alabama. Of course, he's a Florida State guy, but that's neither here nor there. By the time you listen to this, by the way, a number of different things may have happened, okay? Game 5 at the Prudential Center will have taken place. So as you're listening to this, there's either a very good outcome or bad outcome for me, number one. Number two, the New York Knickerbockers, the denizens of Madison Square Garden, a franchise that's been on sort of the trash heap for quite some time, have found their way into the second round of the playoffs, not against the Milwaukee Bucks, the number 1 seed. No. They were eliminated by the Miami Heat in 5 games. So it will be very 1990s basketball, Knicks Heat. And I believe, if I'm not mistaken, the Knicks have the home court advantage, which might prove extraordinarily fruitful. The Knicks a series away from the Eastern conference finals. Can you believe it? Where they'd be playing either the Celtics of Boston or the 76ers of Philadelphia. And by the way, Rebecca Patterson is doing some amazing work on the financial literacy thing. Check out in the show notes. She's having an auction, Ray Dalio lunch, that closes at 5 p.m. today. Today being Friday as you're listening to this. The link to her initiative is in the show notes. Check it out. If you have the means, for you Ferris Bueller's Day Off fans out there, I endorse you to check it out and maybe put a bid on it, because Ray Dalio is a legend in our business. But when we come back, we're going to have that conversation with the aforementioned Rebecca Patterson. So stick around.